Good evening, everyone. A very warm welcome to the session on the future of corporate banking, innovative experience management. We have with us here today two eminent speakers, both technology evangelists and veterans of the banking industry. Mr. Sailesh Panchal is head of the function payments design for Lloyds Banking Group, and in his role, he has led a number of major transformation programs, including the Lloyds TSP HPOS payments integration. He'll be talking more about that later during the session. And we have with us Mr. Nanda Kumar, President and CEO of SunTec Business Solutions. He pioneered the concept of relationship-based pricing in the 90s, and he has been an ardent advocate of customer-centric platforms across multiple industries, including banking and telecom. So together, the two of them will cover the session on the future of corporate banking, innovative experience management. And over to Mr. Nanda Kumar to start the session.
Thank you, Andiswara. And very good evening to you all. Let me start with this quote. This is one of my favorite. When you talk about the species adapting to the changes of a changing world, the agility, and it is not about the strength, the size, the intelligence. It's all about the ability to adapt is what is defining the success of the species' existence. It is very much true for our world today, which is changing like at a speed which is no one ever thought of. I mean, it is the speed at which it's changing, the speed at which the environment is changing is unbelievable. Every other week when it go into another conference, we work in multiple industries. The kind of things which are coming up, the kind of innovation which is coming up is mind-blowing. So in this context, when you talk about, in our context of banking, when you talk about various organizations who has done this kind of adoption and being a corporate bank who's helped in transforming themselves, the one name which comes to my mind is Lloyds Banking Group. We've been associated with Lloyds Banking Group for almost 10 years now. We met with them in 2002 when we were talking about customer-centric pricing systems, and quite amazingly, they were defining the strategy for the next 25 years for the bank. And over the last 10 years, the kind of acquisition, the kind of transformation they've gone through is quite remarkable. And the last one being the HBOS transformation, HBOS acquisition, and the subsequent transformation is something which is very, very important to highlight in this context. And the kind of experience they've gone through, it's something which you all can share, all can learn from. And to talk about that, let me first call Sailesh to come and share his experience, and we will continue our discussion on the future of corporate banking from that starting point. Sailesh, over to you. Thank you.
Thank you, NK. Yes, Lloyds has been on a journey over the last few years with our customers and our clients as a focus. As our CEO has recently said, change is something that's going to happen within the organization, whether it's the kind of integration that we've had or effectively the recent divestment that we've been going through. The most important thing is our clients and our customers and keeping it absolutely seamless for them. Our focus has always got to be on the client. We've got 30 million retail customers. We've got over 1 million SMEs, 250,000 corporate customers. We're managing some £900 billion for them. And it's absolutely critical as we go through this process that change and the way we change is really clearly focused on our client. And that's pretty much what we expect of ourselves and what the regulator is driving us to. The change can be both external and internal. While you're going through change, keeping your focus on your external competitors is absolutely key. you've got to keep an eye on the regulator, as they're going to be changing the game as you go through this. So no matter how big your change is internally, that focus on the external is really important. Internally, you've got to make sure that while any change is happening, your organization is structuring, roadmaps are changing for your technology, your platforms continue to change, your processes will either adapt, evolve, or merge. And then at the same time, you've got factors as an organization you simply can't control. They're going to be occurring around you, be it a recession or be it a hopeful upcoming return to recovery. These things you've got to keep a real focus, and what we've learned over the last few years of change is that by keeping your focus on the customers and their experience all the time, that you can manage that change in a controlled way rather than allowing yourself to be distracted both by internal and external forces. So I'll just talk a bit about the merger activity. So we'll use this as an example. It's a major change within most organizations. Many organizations don't quite get it right. The accessibility and the way it changes your customers, it tends to blind you. So you're thinking, oh, we've got an opportunity, much wider customer base, new products to offer. We can do so much more with this new acquisition. Yeah. And at the same time, you've got this activity that's going to suddenly take over your organization. The opportunity to lose focus, to get the costs and your benefits and your customer off of your main site, so you actually don't deliver the benefits. Okay? And those were one of the key lessons that we were focused on when this first happened. So I don't know whether you remember or how many of you were here in Vienna in 2007, which was, I think, one of the most eventful Siboses and that I can certainly remember attending for all the wrong reasons. This particular one's a lot better for Lloyds, but we're making good and steady progress. So at that point, it was two organizations, pretty much one of the biggest and the third or fourth largest retail organizations and corporate organizations in the country. We had over 3,000 branches between us, something like 32 million customers, and 140,000 people. The expectation from the CEO and our operations chief was set right from the beginning. The activity post-Sibos, or during Sibos, should I say, we had about 20 days to sort out how we were going to go and achieve it, but it was pretty clear. A date was set, a benefits number was set, and we were about to go away and do it. So I think that kind of direction right early on in a merger is absolutely critical to create the focus so that you're really clear, and very much the experience was set that none of the customers in either organization, as far as we could possibly help it, would notice what was going to go on. And I think that is really key, because we had to continue throughout the merger process, which was going to take the best part of 2 years, in a seamless way for the customer, the regulator, and everybody else. And I think to some large extent we achieved it. And we're well on the way as per target, and as you've seen from our recent results, on our trajectory for achieving the benefits we needed from that merger, and we're now in good shape with our client focus to continue on to greater things, which I'll talk about as well. So the challenges from merger are something that you can either take on board or you can actually ignore. But fundamentally, when two organizations come together, you've got to make some really clear decisions around the culture. Yeah? So you've got to have the decision made on what are your key systems, who are your key people, how are you going to organize yourselves, who's going to lead, who's going to follow, and what direction are you going to set. Picking the key people right at the beginning, within weeks, was absolutely critical. But it was done absolutely fairly. we took the very best people from both organizations, and as a result, we were stronger for it. We did it very, very quickly. Compliance, that wasn't optional, but what you'll find is that organizations tend to have different cultures of compliance, colloquially called risk appetite. Okay? You can't have a variable risk appetite during that process, and it was absolutely key that we maintained a real clear focus on what was really important, setting our policies and standards consistently across the group, even if it meant during the process focusing on compliance to make sure all elements of the situation were maintained and compliant all the way through the activity. Last but not least, technical challenges. So having picked the key systems, identified them, when we started that journey, it was in excess of 2,000 systems across the groups, identifying which ones you had to deal with, which ones that you had to merge, which ones you were going to keep, how they were connected, while the organization was in flux was no mean feat. Once you've picked them, deciding what the scale, the opportunity, the use, and the approach was going to be is also extremely challenging. As payments people, though, we work to another set of rules as well, those defined by the schemes around us. Those scheme rules won't change and don't change just because you're merging your organizations. So you have to maintain those. And in the UK, with faster payments, a 24/7 service making immediate payments within a few seconds, created absolutely a focus on making sure we were well aware of the schemes and the impacts on them to our integration challenge. So if I just go into that integration process. So it's a business and IT problem, yeah, at all times. So the business are giving the IT organization an awful lot of trust during this process. Yeah? There's a degree of assurance that anyone can do, but when you're trying to mobilize, as was in our case, something like 10,000 people on one focused goal, on one single date, it's an organizational challenge. And the business were completely and utterly on board, both with understanding the nature of the challenge and understanding what we were trying to achieve. So, certain elements, data, yeah. You have to get your data together, those kind of integration challenges. So we moved the equivalent of 58 million customer accounts, all of it moved and accounted for down to the halfpenny throughout the process. That kind of movement of funds and the number of 11 dress rehearsals requires exquisite, perfect planning. We had something like a 400-item go-no-go list throughout the process. Within that process, you're checking all the time to make sure that your customers, be they at the retail counter, on the internet channel, are getting the same view and the experience that that they are used to. It makes them extremely nervous throughout the process if anything starts changing. So you've got to get that view and the planning right for that. So things like rebuilding internet channels so that the seamless experience of security credentials throughout the process is absolutely key. The business assurance activity, yeah, as I said, the business were absolutely hand in glove. They worked with us through 32 weekends, working with us to test everything that we were doing every single weekend throughout the process, being both forgiving and critical and equal measure and grateful as the systems worked and they processed the transactions through, making sure that they were there to look out for the customer and the customer experience throughout the activity, while IT was focused on making sure that that activity happened as per plan and schedule. All of those things, you are cutting across system silos because effectively you will have two organizations which will work slightly differently. Okay, so if it's a payments process, you'll be surprised just how many different ways people can implement payments and the mechanics associated with them, the services around them, and organize their various organizations around the business and operational processes that the customers will experience, be it, as we're going to talk about in more detail, the billing statements, etc. All of that makes you break down the barriers between your organizations, understand your target operating models, and deliver really clear systems, structures, architectures. To give you an idea, we went through some 4,500 service chains end to end to make sure they were consistent throughout the process. And last but not least, I guess, the scalability and flexibility of your IT systems. Yeah? So scaling may appear okay, but one of the things is, very few organizations have to maintain an absolute control over the currency and versions of all your hardware, making sure that you understand that you're going to be able to go through a 2-year process of daily, weekly, weekends of change, and understanding how you're going to create stability while you're scaling your platforms, making sure your software doesn't go out of support during the process. And one of the things that we really focused on was to make sure that our service levels to our customers were maintained at a very, very high level. And it stood us in good stead. So our service availability levels are now better than 3 nines in most weeks. So we're really proud of the processes we put ourselves through when we were achieving this integration process. So we'll look at one of the key elements. So during the process, we identified more than 400 what we called customer critical functions. These were the things that the business were testing to make sure that the customer experience did not change and they would not identify that there was a merger going on just a few inches below their browser. And one of the key elements was billing. As you can imagine, one of the first things the customer notices between one organizational change and another is if their bill is substantially different. So you have something like 350,000 customers to migrate. You've got increased number of accounts, new product lines, and quite a complex customer experience throughout the process. So we went through really clearly with our partners at SunTec, understanding exactly what the HBOS customer models were like, how the customer bill was constructed in completely different systems, and they had the flexibility to enable us to reproduce and test all of the billing processes and create the rules that were necessary. We went through over 11 testing cycles with real live data to make sure that the amounts tallied up. So just in case the customer asked for a bill from last month, the numbers would still add up and were consistent. That information and understanding the product mix was absolutely central to that key customer experience, keeping that 400 plus customer critical function right in the center of our view, making sure it was completely seamless and consistent for that customer experience. And in that process, we really did understand the complexities in billing with our partner here in terms of understanding the value of that customer relationship. That element has really just kept us going. That was the beginning, and you can use merger as a stop or a start on your organization, or very much what it did to us was instill a corporate culture of customer-centric behavior. We're now looking at the customer experience throughout all of our touch points. In many of our, I think many banks that I've been in the past as well have said they're customer focused. I think Lloyds, we're really putting that to the test more than I've ever seen. Consistent across all touch points. We're developing products which are putting the client experience at the beginning. We've been through many situations throughout the event where effectively transparency and clarity to the customer staying consistent with the terms and conditions has been absolutely central, and making sure that the service produced by the products was consistent and customer-centric. As you know, the UK has been, shall we say, plagued recently by mis-selling scandals and things like that. Our CEO was absolutely central in making sure that we as an organisation put the customer first throughout that process and acknowledged what we should be doing as the right thing to do for our customers. That has driven, surprisingly, all the way through the architecture. It's driven our funding and our approach through architectural building blocks. So the important thing there is that we're taking a really clear transaction management approach to our processing of payments. So that's every single payment through all types, trying to achieve a really consistent approach of transparency and clarity. And we're doing that by making sure we're logging all events that occur to the payment and all of the life cycle of that activity. We're making sure, as through regulation, and that we've got the reach within the UK that we need, and that all our channels are going to be upgraded to support that ethos and ethic. So throughout that activity, the approach we're taking is managing each of the transactions, and we're basically creating a single transactional operational store that's starting to log all of those transactional events. During the merger, we created what we call the single customer view. That genuinely creates for us a single repository for all of our customers. And thanks to FATCA, and this is the approach where you can use regulation to your benefit, we've done that for all of our global customers. So we've got a single point of references for our balances and our transactions. Now, that legacy of continuing to focus on the customer, understanding the opportunities that mergers provide, now enables us to go the next step forward. As we see that single repository enables us to be really clear about understanding what billing and pricing is going to be driven by those events. We can be very granular and use that to influence behaviour in future, to encourage the right kind of behaviour and be really clear with our customer exactly what they're being charged for, and be honest about how our terms and conditions match up to our billing commitments. This will improve our service to our customer. It'll make sure that we're clearly competitive on the right things, and we will continue to focus on that right behaviour. So I'm just going to hand over now to NK, who's got experience across a multiple number of industries with the right way to do billing, and he's now going to talk to us about that. Thank you.
Thank you, Sailesh. Thank you very much. We've been, as an organization, has been talking about customer centricity and customer evolving organization around customer focus for many years. This is something which we have a background where we started from the telecom industry almost 20 years ago, completely in an environment where it was all about products, nothing to talk about customer, and then a complete transformation into customer-centric strategies. And when we went through this process, we realized that this is something which could be applied to any industry, and that's how we started the journey in 2000 in the financial services. And ever since that, we dealt with many organizations, and the story of what Lloyds just outlined here, even when we've gone through one of the phenomenal transformation, phenomenal change, and changing within the organization, one single aspect of just focusing on the customer could make the whole experience of transformation seamless, and the customer didn't know about it. That's what Sailesh has presented to us. So then when we start thinking about what would be the future of corporate banking, or the kind of banking, for that matter, given to the corporate in the future, what would that be? There's a lot of things that goes to your mind. You can see innovation happening in every part of retail, or a lot of stories about it. So when we start thinking about the corporate, what would that be? So I've been thinking about it, and then one of the fundamental things is to take what is the current scenario. Let us look at the current scenario. If you look at any corporate, they've got multiple banking relationships. They've got a huge department, which is the accounting department, spending time in reconciling between the banks and their accounts, and it's a nightmare. And every time they go to a new bank, it is all about negotiating new prices and schemes and pricing systems. And if you go back with all this kind of choices and preferences, they're still not happy. And if you go back and ask this question, why is this? There is a huge difference in between the expectation versus the experience. This is one of the reports which recently came up as conducted by E&Y, trying to find out what is the difference between the expectation versus the experience of customers, corporate customers. There are a lot of factors here, but I really wanted to focus on two fundamental points. One, the transparency, and the second one is about innovation. If we talk about transparency, why transparency is very critical? Sailesh talked about the transparency they brought in their environment when the customers moved from one organization to a completely combined organization, how they defined the transparency and the granularity in which they did the transformation helped maintain the customer experience, and it made the whole transformation seamless. Now, transparency has got a direct relationship to one of your fundamental reason why you're existing as a banking organization. For any bank, it is about the trust with your client. You are dealing with customers' money, and they want you to be a trusted partner. The aspect of transparency is about bringing that trust back into the table. We know the kind of challenges we all went through as a banking organization from 2008. And this is going down day by day, as you can, all the researches, and you can see at least it is shifting a little bit, coming back. But the reality is that it was at the lowest, and then it is picking up. One of the fundamental thing is about bringing the transparency. So there are systems. This is a great deal. I mean, it's not that banks are not wanting to do it, but the technologies and the operational challenges help them. But the good part of the story is that today there are technologies and technologies are evolving, which are making this transparency even possible at a very, very highest level of details. We work with organizations where this is one of the fundamental drivers for the whole transformation. They're bringing in, we are bringing in capability by which every element of customer interaction is monitored and recorded, and those factors are used for deciding the charges and the fees for the customer, but then at the same time, the granularities, the granular details are maintained and made available to the customer to continue on this. The second aspect is about innovation. When you talk about innovation, this is something which has always been talked about big time everywhere. But we need to understand why this innovation is one of the fundamental considerations for any organization in the future. The world is changing at a rapid pace. We talked about that at the beginning of this conversation. And the business your customers are in are also changing. Their environment is continuously changing. So there is no way what they've been doing in the past is going to sustain in the future. So the corporates are busy with redefining their business and dealing with the challenges. So when they're doing at these levels, you need a partner who can help them in managing their finances. So if you as an organization is in a position to innovate at the same rate as the organizations are innovating, you have a chance to support your customer. So this is, if you focus on these two fundamental aspects, that one is the transparency, and the second aspect is about innovation. And the innovation to help your customer's business, we have a starting recipe to define what is the future of the corporate banking should be. So it is not about innovation at the first attempt. It is innovation on a continuous basis. Now, it is important for us to define what is innovation, how we translate this into something which is actionable. So when you talk about innovation, if you talk about many of the happenings around us, the true innovation is when you are abstracting the usage of your service from the technology and the operation. What Apple did with iPhone is all about that. It's not about technology innovation. They abstracted usage of your phone or your MP3 player and the experience of music, listening to music, from the technology of the MP3 players or the phones. The same thing is applicable for the corporate bank. For a corporate, what matters to them is the financial management. If, as a bank, if you are in a position to understand the customer on a continuous basis, their business challenges, even before they are able to understand those challenges, and then provide products and services of the future, that is what is going to define the future of corporate banking. We've been working with large banking organizations all across the world, right from Singapore, Asia to North America, deploying systems which fundamentally helps banks to, on a real-time basis, analyze a customer's transactions, understand customers' behavior, and utilize them in terms of charging as well as computing benefits for the customer. And the systems are completely transparent. It brings in the fundamental ethics of the business, which is the trust, not only bringing transparency as well as bringing in complete innovation in the way in which the banks, our clients, are supporting their clients. And that's the kind of transformation which is going to define the future of corporate banking. When you talk about the trust, going back to the trust, the innovation which you bring in also brings in the dimension about the future proofing of your customer. And today's technology, which is the big data analytics or real-time analytics, are the ones which are enabling this, which is what bringing back to your this trust factor which we talked about. And in other words, the future of banking is all about taking care of the business of your customer, helping them to go into the greater heights, helping the banks to, your customers to do their business better, is going to be the business of a corporate bank of tomorrow. With this, I conclude my few thoughts for corporate banking. And the floor is open for question and answer, fundamentally to Sailesh, and anything which I can add, I'll be more than happy to share my thoughts too. Thank you. Any questions? No.
When you were reorganizing the two banks together, what was, you said you had a definite benefit that you had to achieve, so what was the strategy to go about achieving the customer experience that you were able to maintain, whereas also to achieve the benefit that you were required to achieve by your CEO?
But fundamentally, the customer came first, all the way through the process. The benefits case was driven from an understanding of the business processes that we did during the merger. Yeah? So effectively, we went through the organization to say, okay, where's the duplication? Where's the opportunity for simplification post the activity? So there was no skimping, let's put it that way. So the merger was done for the execution to be completely seamless first, and that was really, really clearly the objective, so whatever that took. The understanding of the benefits that came from it was immediate afterwards, so based on both people, organizational structures, and the processes that we understood, each one of the, if you will, directors shall we say, went through a process of understanding the benefits realization activity. A very clear program was initiated to drive those benefits through by our COO, to make sure that we managed to deliver the results, basically. So it was a two-step process. Make sure the merger is executed as perfectly as possible, be really clear what the benefits were by the plan during the merger, and then deliver to those benefits.
Did you use any specific index?
So, sorry, just...
Any specific index which you used in terms of computing the index?
So, in terms of actually trying to, calculate how big the benefit was going to be, in terms of working that through, I think it was basically done very simply. It was a case of, let's think of a number when we knew the merger was going to cost X, and we'll double it. Now, I'm sure there was an awful lot of, shall we say, consultancy time developed on the accuracy of that number. But basically, because the various directorates were responsible for submission, understanding the business divisions, we went through, in payments, for example, fairly extensive analysis around the operational controls, the processes involved, the number of staff that we would need to derive what the target operating model was going to look like post-merger, and effectively a fairly clear plan around how we were going to affect the execution of that benefits case. And since the merger, that was tracked on a week-by-week set of meetings.
Thank you.
Any other questions?
Any other questions?
Sorry, can you just repeat the question?
I've got this now. Do you have a sense in percentage terms of the value of revenue leakage you stopped with the implementation of this pricing billing system?
Well, I think that one of the key pieces we did during the activity was to look at whether the billing system was actually going to be a key critical factor, okay? So it wasn't a revenue leakage perspective. So to give you a fairly honest answer, I think it was done on the basis of understanding the customer's current product and what the pricing was. It wasn't done, as I said, the customer experience came first. If there was any profit and loss as a result of billing changes, that was put to one side, because the key factor was to make sure that the customer didn't get detrimentally impacted by the merging process. I think in terms of optimization of the customer experience and what we've been subsequently been able to do in terms of protecting, the key goal was to, one, make sure the merger was seamless, the customer wasn't impacted, and then after that we would drive any benefits case that was going to be made.
There is another, I can share one situation where in another deployment we had almost about 10 to 15%. It was a kind of revenue leakage which we could quantify. This is another large bank. But in your case, it was all about, even if there is a revenue loss, you didn't want to change the customer charges at any cost, because to maintain the customer experience was your focus. Yeah. That is the point. But we have a couple of other scenarios where definitely yes, there were significant revenue leakages because the charges and systems were evolved over many years, and there was no mechanism to audit what the kind of fee rules have gone in, and which caused a lot of revenue leakages, and which we could plug once you redefined the business rules under which it was engaged.
I think the point to add was that in any organization, exactly how billing works can be an incremental art, okay? And so there was absolutely, shall we say, new clarity understood as to the nature of the billing process in HBOS and how that number was derived, because you've got a variety of systems and processes that accumulate to that value. I think the business understood the product and the customer experience better, and subsequently, obviously, I think our own product portfolio development has improved as a result. So I think it's while I don't think I've seen a number internally quoted, I think the balancing act is more from an improved understanding of product and billing and customer behavior than anything else. And I think over time, that's become valuable in itself.
Yeah. Any other questions? Yeah. Yep, if it is not the case, thank you very much. Thank you for joining us in this discussion. Thank you. Thank you once again.